Hello, I'm Lindsay Hall, Chief Market Strategist for the RMB Group. Welcome to our video series, A Short Course in Futures and Options. In this lesson, we will cover futures contracts and provide a learning example for you. Let's get started by covering myths and realities, as well as risks and rewards. There's a great deal of mystique surrounding futures contracts. Many respected financial professionals, including most stockbrokers and financial advisors, will caution you against getting involved in futures and options. Many will dismiss these markets as nothing more than pure speculation. In part, they're right. If you use the traditional roll-the-dice methodology practiced by many beginning traders and brokers, your odds of success are very low. Because they can involve a high degree of leverage, futures and options may entail a high degree of risk. But when used properly, as we'll show, they may provide exciting and very substantial rewards. A futures or commodity contract is an agreement between two people. The seller of a futures contract agrees to deliver a specific item to the buyer of the contract for a certain price on a fixed date in the future. The buyer of a futures contract agrees to take delivery of the same item under the same terms. The buyer of a futures contract is said to be long the market. The seller of a futures contract is said to be short the market. Futures contracts are essentially paper transactions in that they do not involve the purchase and sale of the actual investment instruments themselves. They are contracts for delivery at a future date. Because no delivery takes place prior to a specified period, no money actually changes hands. The buyer of a futures contract does not have to pay money, and the seller of a contract does not receive any money. Rather, both the buyer and the seller must post margin with their respective brokers. Margin requirements are set by the individual exchanges and, for the most part, are based upon volatility and not price. Unlike stocks, the treatment of long and short futures contracts positions is identical. Unlike a short seller in stocks, the seller of a futures contract does not need to borrow his contract from another party, making it just as easy to sell as to buy. Unlike stock margin to trade a futures contract is not a down payment on a loan. It is a performance bond that guarantees your broker that you're good for a fixed amount of losses. Not only do you not pay interest on a margin deposit, you can receive interest while using the money to back up your positions. How? By posting margin with your broker in the form of a U.S. Treasury bill. Since a T-bill is backed by the U.S. government, it is nearly as good as cash, so most brokers accept it. Meanwhile, you get to keep the interest. Here's a learning example. Let's learn how to create our own oil well using futures contracts. Even with the economic meltdown of 2008, one of the biggest macroeconomic stories of our era is the growth of the global economy. Exploding growth in Latin America, India, and China have dramatically increased the market for essential commodities. The world's most essential commodity is crude oil. Not only does the global economy run on crude oil, but most of the world's supply comes from the politically unstable Middle East. This makes black gold extremely vulnerable to price spikes, especially while oil production is declining. There are 5 possible ways to profit from higher crude oil prices. First, you could rent a tank farm, fill up your tanks with crude oil, and wait. This is highly impractical for the majority of investors. Second option, you could buy stock in an energy company like Chevron or ExxonMobil. Third, you could purchase an energy mutual fund or ETF. Fourth, you could buy crude oil futures contracts. And fifth, you could buy crude oil options. Since owning crude itself is out of reach for most investors, we will compare the risks and rewards of the other 4 alternatives. We will also use this comparison to highlight some of the characteristics of futures and options. Let's look at the crude oil futures traded on the New York Mercantile Exchange, or the NYMEX, a division of the CME Group. Table 1 is a reproduction of a daily price listing from the Wall Street Journal's website. Daily prices of other major international futures contracts can be found in Investor's Business Daily and the Financial Times. Perhaps the most complete listing of global futures and options prices is weekly on Barron's website. Also, nearly every major exchange has prices for futures and options listed on its website. Note that the contract size is 1,000 barrels and that it trades in dollars and cents per barrel. The settlement price of $74.52 for the December contract means that on the close of trading that day, 1 barrel for delivery in December of 2009 was worth $74.52. To find the dollar value of one December crude oil contract, simply multiply the contract size of 1,000 barrels times $74.52. At the close of trading on this day, one December of 2009 crude oil contract was worth approximately $74,520. $74.52 times 1,000 barrels equals $74,520. At the time of this record, the margin or performance bond required to trade a crude oil futures contract was $7,800. Assume, for example, that you purchased a December crude oil futures contract at the settlement price of $74.52, and the following day, crude oil rose 2% to $76.01. How much would you make? Simply subtract $74.52 from $76.01 and multiply the contract size of 1,000 barrels, and you get $1.49 times 1,000, or $1,490. This return of 19% on your margin of $7,800 would be physically added to your futures account on the next trading day. You would be able to withdraw it and still hold the position. Conversely, if instead of rising, the price of crude oil declined by 2%, that same $1,490 would be physically deducted from your futures account. An important point to make: unlike stocks or the purchase of options, there is no such thing as a paper gain or loss in futures. Both are realized immediately. You could be required to add more money to the account in order to meet your minimum margin or performance bond requirement. This is known as a margin call. If the value of crude oil dropped far enough to exhaust the amount of cash in your trading account, your position would be liquidated and you would be responsible for any additional money required to bring your account back to zero. It becomes obvious quickly that if all you have to trade with is $7,800, crude oil futures are probably not for you. A good rule of thumb is to have at least twice the minimum margin required to trade any futures contract. Assume you believed that the price of crude oil was going to increase. Instead of spending $74,520 for an equivalent amount of crude or energy stock, you could set up a futures account, deposit 2 times the initial margin, or $15,600, and buy a December crude oil futures contract. Take the difference between the $74,520 you would have spent for a crude oil or equivalent stock position and the $15,600 futures market margin and invest it for 2 years in super safe T-bills or short-term treasury notes. You now have a well-margined futures position with the bulk of your money busy earning interest somewhere else. The commission to do this trade should cost no more than $50 for the futures contract and $50 to purchase the T-bill. T-bills can be purchased for no charge directly from a Federal Reserve Bank. The futures commission is quoted round turn, including both the cost to buy and sell. Compare this with the incredible costs of owning crude outright, tank rental, etc., or the diluted results of owning an energy company or targeted energy mutual fund. There is no guarantee that the stocks of energy-related companies will rise in tandem with the price of crude oil. Differences in management, inventory practices, and the overall direction of the stock market can cause the price of an energy company or set of companies to fall, despite an increase in crude prices. Owning crude outright via the futures market offers a pure play advantage you cannot get anywhere else, outside of owning the physical crude outright. This advantage extends to other markets as well. Now that you have a sense of futures, let's move into our next video, which covers the option alternative.